Well, it looks as if markets have been waiting for something even more inspiring than just a delay in a sales tax hike. Overall, the delay in the sales tax hike was basically expected throughout the year. The signals were becoming stronger and stronger, so this is just an announcement. What it means for investors is that in Japan, policy is moving from monetary policy to fiscal policy. This usually means a stronger currency. It usually means lower asset prices or not so strongly growing asset prices, and you see the reaction on that.
Fiscal what, though, Martin? When you say it moves to fiscal policy, what are we talking about here? I mean, what kind of fiscal policy makes sense at a time like this for Japan? Everything works against Japan. The demographics work against Japan. All this previous hope that there was going to be reform on immigration, labor reform, that remained just what it is, talk up until this point. So what exactly do you point to when you say fiscal reform? What do you think is the first order of business?
Well, so far, the impact of monetary policy was quite limited. The main reason is the government was buying bonds from the private banks, and they left it in their accounts at the central bank. Very little of that had an overall impact on the private economy. What we are seeing now with a shift towards fiscal policy is a direct monetization of a lot of public debt. So the overall debt load in private hands is actually coming down in Japan very fast. That helps in the long term. What we are also seeing with the government now pushing on the pedal for fiscal policy is they are focusing on those sectors where actual demand is. This is not so much in investment because Japan is aging and shrinking. It is not so much on the household side because they remain concerned and keep saving. So the government is now investing more into healthcare, into younger families, into education. There is a lot of demand, and that might help in the long run. In the short term, of course, as a positive impact on asset markets, on stocks, it will be rather limited.
Okay, how do you pay for it, though, Martin? I mean, it's good to spend. Keynesian spending in times of duress can be very good if it's targeted at parts of the economy that need it the most. In terms of revenue enhancement, though, revenue raising in Japan, what can be done? Japan has already embarked on some things in bold. I mean, they do have a lower corporate tax rate than the U.S. has, don't they? Don't they have a lower tax ladder than the U.S. at this point? At the corporate ladder, at the corporate level? I mean, they've been aggressive on that front, haven't they? What else can they do?
Well, this is one of our frustrations in industry. Actually, our tax rates remain rather high, although they have come down a tiny little bit. What we are seeing right now is a major change in overall policy setup. Monetary policy not cutting it so much and now moving towards fiscal policy. What monetary policy will do will be an outright finance of fiscal policy, of overall spending. This is a big change as long as we are not seeing major inflation, and we are still very close to deflation in Japan. This is a very cheap tax, and this is a very cheap way of getting the economy moving and trying to get one of the engines a little bit out of its sputtering state and getting the domestic economy moving. I expect this to work quite well during this year.